you've got a bunch of target date funds in there, that's probably half of your options, and you should only choose that one. Mm-hmm. To me, that's the real downside of using a 401k as where you're going to put the old 401k funds as opposed to an IRA. So when you put it into an IRA, especially if it's one that's managed by a professional investment advisor, the number of options that you have to pick from is so much greater. It's basically anything that the advisor is licensed and willing to use.
Not to say that the money in your 401k is not your money. It is your money, but that is not your account. That is the account for the employer, right? And that account exists for the benefit of the employer. Now, not to say that you don't benefit from the account as well, because obviously you get a match from the company, right, and you get tax deferred growth and all that other stuff, right? That are benefits of a 401k. But that account exists because it is a tax write-off, basically. It's a benefit that your company offers, and they get a benefit for offering that benefit to you as an employee. That is why that account exists. It does not exist for your benefit. Welcome back. Thanks for joining us here at Family Wealth Planning Partners. Want to do another edition of the Retirement Planning Happy Hour, and we have got a bottle of Woodford Reserve, and this is a special bottle. This is the Blended Malt Sherry Cask Finish. So getting a little special on this one.
We're gonna get fancy this week.
Get a tad bit fancy anyway. So we'll be tasting that throughout our discussion today. And today we're going to shop or really talk all things 401k, right?
401ks, consolidations, kind of stems from a new client that we brought on this week that just, you see this all too often. I thought, what a great example to say, hey, this is what we see a lot of people doing. And let me show you why it creates problems and show you an easy solution to kind of take care of that for you.
Yeah, and I think that's pretty much where we get the gist, or get the most of the topics for these conversations that we have, right? Just comes direct from client meetings and from new prospects that walk in the door and things that we're discussing with our clients, and figure if it's of interest and things that we're talking about to them, we should probably be opening up and talking to everybody else in the world about it, right? So what were some of the main topics that you were discussing with that specific client, and what were the takeaways?
Well, so this was a new client that came into us from a workshop that we did over at U of L Shelby campus. When they came in and we looked at everything, their biggest concern was, do we have enough money to last? Okay, we get that question a lot. It's kind of the real crux of financial planning, is making sure that the money lasts longer than you do. Okay, so we start with that. They gave us a list of all the accounts that they had, right? And one of the things that we do, and if you've never done this is a fantastic exercise, is to actually write down what you have and where you have it. It's always amazing when you start going through that. People don't realize this account that you've got here, that's actually an IRA. And this account that you've got over there, that's a brokerage account. Oh, I thought that was an IRA. So going through that exercise, just figuring out where everything is a big deal. So when they gave us the list,
I will say it's amazing to me the number of people that we meet with or talk to that just have pockets of money all over the place, and they don't know. There's no rhyme or reason to why is that money there? Well, that was something. I think that was an old plan, maybe, and they did something with it, or they don't really remember, why the money is where it is. They never went to the trouble of consolidating it or doing anything with it. So there's no cohesive plan or structure.
There's no plan of any kind. It's just random. It's all over the place. Yeah. So in this particular client, perfect example of it, they didn't know whether their money would last long enough because they didn't really understand what they had. So we looked at it. We had a couple of small annuities that were done back in 2008.
Of course.
Gee, I wonder why they were doing it in 2008. That's a podcast in itself, right? They weren't very big, but the problem was when you look at them, they'd left them there for a long time. These were annuities. They were a fixed annuity that were guaranteed to get, are you ready? 3%.
In 08.
And no. They got 3% every single year since 08. It's like, wow.
Yeah. Well, that's what I'm saying. They took the product out.
Exactly. And we see a lot of that from 08 because that was people panicking over the market crashes that were happening back then. So they had a couple of those. They were very adamant that those were not retirement accounts. But when you look at the statement underneath the annuity said IRA. Well, that's a retirement account,
Yep.
right? It's designed for that.
It's probably more equivalent to a savings account.
Yeah, at 3%, definitely.
But that's neither here nor there.
But they had multiple old 401ks, which I want to kind of talk about that here in a minute about why that's an issue. They had 401ks from 3 different previous employers, and those were held at 3 different custodians.
Of course.
They had multiple IRAs and Roth IRAs at 2 other custodians. So it was one of those things, they literally just had stuff all over the place. And Eric, to your point, they probably had talked to somebody somewhere along the way that said, oh, you should do this. And they were selling a product, and that's where they got the annuities. And then somebody else said, oh, you should do this. And maybe they had a neighbor who said, oh, well, we use this company. And that's how you end up with stuff just all over the place. It's amazing how people don't understand that consolidating into a very small area is just so beneficial to you.
Well, I was going to ask, and maybe you don't know the answer to this question, maybe you didn't get it, but I was going to ask because you said they had multiple IRAs with different custodians.
Yes.
So did they tell you why?
No, they did not. They did not know why. I asked. Okay. And it was one of those things. We did this in 1996.
Yeah. So what I hear whenever I see, especially individual accounts, like IRAs, Roth IRAs, whatever you may be, that are at different custodians, it's always interesting to me when I find out why. And 90% of their time is because they wanted to diversify their portfolios. They didn't want all their eggs in one basket. And so then that always leads into a greater discussion of, well, you're not achieving the goal that you think you're achieving.
Right.
Just because you have an account at Vanguard and you have an account at Fidelity doesn't mean you're diversified. Fidelity and Vanguard, in this case anyway, are acting strictly as a custodian. But if you own an S&P 500 fund at Fidelity and you own an S&P 500 fund at Vanguard, you're not diversified in the least. Just because you're holding an S&P 500 fund at 2 different locations, you're still holding the same fund. It's just having 2 different cookie jars, but if they're both filled with chocolate chip cookies, it doesn't really matter.
And even better, they're the same chocolate chip cookies in both cookie jars, right?
So there's not even like a chocolate oatmeal raisin in one or something, right? There's no diversification between the cookies. The cookies are the same. Just because they're in different cookie jars doesn't make them something different.
I actually saw that with an elderly client a few years ago, and you see this with older people more often.
Oh, for sure.
With banks. Mm-hmm. This particular lady, who's now deceased, she was very adamant when I talked to her, and it was her very much adult children. Her kids are in their 60s. We were sitting there talking about it, and she said, well, it was very important to me that I not have all my stuff in one place because I didn't want anything to fail. Okay, I get where she was coming from. And think about it. This is a woman who lived through the Depression. And
I 100% the idea was correct. The execution was
correct. So she had CDs at, I think there were 5 different banks where she had CDs. And I'm going to stress this to you. None of them were $250,000 or greater. So if you know that number, that's where FDIC insurance kicks in. So she's moving them around to different places to make sure that she was insured. But she could have consolidated almost all of them and still been under the 250 limit. So the diversification was, I started using the phrase geographic diversification. She was all over town, but she had the same chocolate chip cookies, not good chocolate chip cookies, by the way. She had the same things everywhere. If she had consolidated it, it would have made her life easier. She was tracking this stuff like crazy till the day she died. After she died, because we had not gotten everything built out before she passed, spending time working with her kids, just trying to find everything took us several months.
Well, and that leads to the greater discussion because you said that she had them at 5 different banks?
Yeah, something like that.
5 different banks, 5 different bank accounts. So you're getting 5 different statements.
Yep.
Right, from different accounts. You lose track of one of those statements, or one of those statements gets lost in the mail, and then something happens, and it sounds like this is what you went through, right? So you're trying to track all this stuff down after the fact, and it only confuses you more and you lose track. This is how you lose track of your investments, and this is what derails plans, right? You don't know where everything's at. You don't know how everything is accounted for, and if something's not properly structured in the way that it should be, that adds an additional layer of risk potentially to your portfolio.
Yeah, risk of loss, not from poor investments, but from I can't find this. Where to go?
Well, you can't find it. I mean, where those? I think every state has these, right? You can go online to these websites. It's like the unclaimed assets,
unclaimed property, or something like that. Yeah,
yeah. So and a lot of these are just situations like this. Like there was some inheritance or some account at a bank that no one ever claimed, and it's under someone's name, and just things get lost all the time. It's amazing how often this happens.
Funny story. I'll sidetrack our conversation for a minute. Years ago when I learned about unclaimed property sites and all that, I went to the one here in Kentucky and I started searching just to see if there were some lottery winnings or something that I had. Of course, I found nothing. So I searched on my wife. I actually found something. Now, keep in mind at the time that I did this, we're in our early mid 40s. I found a unclaimed Wendy's, as in the fast food chain, paycheck. Uh-huh. She worked that job when she was 16 years old. It was her very first job. She actually worked for the Bridgman family, here in town. But she had a $71 paycheck from, I'm not going to say the year because if she watches this, I'm going to pay for that, a ways back. Let's just say there have been multiple presidential administrations since this happened, right? But no kidding. If you've never checked out the unclaimed property, you might. But your point is 401ks get lost. If you've been doing this long enough, you've encountered somebody who has lost an old 401k. I had a lady I was helping years ago. I tracked down, it was about a $30,000 401k. I never did find it. And what happens is, just to let you know with 401ks, so while you are working for the company and you're under 59 and a half years old, you can't take the money out of the 401k. So you leave the company and you don't do anything with it. And we'll talk about what your options are in a minute. You don't do anything with the 401k and you move from the company you were working for to a new company. Okay. Then you start a new 401k there. Now, the old company then decides they're going to change providers from Fidelity to Empower, for example, right?
Happens all the time.
It happens all the time, right? The Empower offered them some kind of great deal, and they said, yeah, we'll move it. Well, you're not thinking about it that way because you're no longer working there. Then your company gets bought out by another company who uses another 401k provider, and then everything gets switched over to the new provider. And that happens 2, 3, 4, 5 times. All of a sudden, you're having trouble finding your money, right? And my attitude is, I don't care if it's $30,000 like the one I was telling you about, or if it's $500. It's your money. You should be able to get that moved, right? So,
and I'll even throw in one more thing, because sometimes once you've been gone from a company for so long, depending upon the custodian that those assets are with, and I know Fidelity specifically will do this, and there are certainly others that will also, but they will just move your money into an IRA.
Yeah, they will. That's exactly right.
They'll just get the money out of the 401k. So let's say you talk to your old company and they said, oh, yeah, but we're with John Hancock now. Well, because they switched from Fidelity, Fidelity, that plan had moved you because it was inactive, had moved you into an IRA. And so now you don't even know what you're sitting in an IRA account, maybe something like a money market or something like that. And so now you're like, well, you're talking to your old company and they're telling you with John Hancock and they can't find your account. And so it's just another layer. It's another hoop that you have to jump through to try to find old money that's been sitting there. I just actually left a client meeting this morning, as a matter of fact, and he was talking to me about his daughter, and she has 3 different 401k plans from different companies that she's moved. Now, they're not large and she's still young.
But it's still her money.
But he's told her, he said, you need to consolidate. Here, talk to my guy. And so I'm going to be meeting with the daughter here relatively soon. But she just hasn't consolidated a lot of these old plans because she didn't know what to do. And because she didn't know what to do, she just stood in place, right? And didn't do anything.
Right. So let's talk about what your options are. Yeah. When you leave an employer and you had a 401k, or 403B or 457, they all effectively work the same way. Depends on the type of employer that you have. You really have four options.
Well, they're IRS codes. I'll add that
Yeah,
too.
that's correct.
Because most people think of 401k as like an account. I mean, yes, it is an account.
It's a paragraph in the tax code.
It's an IRS tax code. Yeah. So is the 403B. So is the 457. That's all that it is. Yeah. And everyone says, "Oh, my 401k is doing really well, or it's doing really poorly."
No, the investments inside of it are doing that right.
The 401k is not doing anything.
So the 401k, and the example that you like to use when we're talking to workshops, is it's a cookie jar. Yeah. You're not going to eat the cookie jar. It's the cookies inside that have some kind of value to. So anyway, when you leave a company, you have four options. There are only four. So option number one, you can take the money out in the form of cash. Pros and cons. Instant liquidity. Con, if you're under 59 and a half, not only are you going to report the entire thing as tax, that includes Roth, by the way, which you thought was going to be tax-free, not when you break the rules like that. But you're also going to have a 10% tax penalty on top of that. So when you figure in federal tax, state tax, depending on your state, here in Kentucky, you're at, I believe we're at 3.5 now. Is that where we are this year? We have 4. And then you take in the penalties. Realistically, you're going to be in the high 30s to low 40% range. That's going to be taken right off the top. So in my opinion, the cash out option, you are robbing Peter to pay Paul if you're doing that. There's no circumstance in which this is a good one. Okay, but it is an option. Okay, option number 2, leave it where it is. Now, we already talked about all the cons. Yeah. But if you don't know what to do, so you just left the company, a couple 3 weeks ago, and you haven't talked to a good advisor yet, okay, leave it there. We can always fix that. You just don't want to leave it there for too long. I think that's where the real problem is.
Correct.
Don't go to a dinner seminar and some guy in there is hawking some kind of product, and we know what kind of products they're typically going to be doing in there, and say, oh, that's what I'm going to do, because now you can't change your mind, right? Just leave it there for the time being. Option number 3, sometimes, usually, but not always, you can roll your old 401k into your new employer's 401k, right? Now, from a pros and cons point of view, it's clean, right? Everything's in one place.
At least it's consolidated.
It's consolidated, that's right. The biggest problem, I hear people say this one, it's just mind-blowing. I want to roll my old 401k into my new company's 401k because then I get the match on it.
Yeah.
No.
That's not dependent.
It's not how it works. The new company is going to have a match based on new contributions, not rollovers. It doesn't work that way. I can assure you, if your company says, oh, we match to, say, 5%, and you roll over $250,000, they are not going to match that. It's not going to happen. It does consolidate everything. Depending if you are a fairly high income earner, this is actually not a bad idea in order to do backdoor Roth contributions. If you are over, what's the contribution limit this year? Like 240 something. That sounds right. So if your household income, and if this is married filing joint, 245,000, 250,000, somewhere in that area, you're no longer allowed to contribute to a Roth IRA directly. That's where you can do a backdoor Roth. Give us a call if you got a question about that. So that is a viable option. Just don't think that you're going to get the match. Or option number 4, that's my default because the pros so far outweigh the cons, is to roll it over into an IRA. The beautiful thing about an IRA, because it's yours, it's never going to move unless you move it, right? It belongs to you. It's got your name on it. It's not associated with any company. It's simply going to be at the custodian that you or the advisor that you're using chooses to.
It's important to note that is your plan.
Yes,
now,
exactly.
not to say that the money in your 401k is not your money. It is your money, but that is not your account. That is the account for the employer, right? And that account exists for the benefit of the employer. Now, not to say that you don't benefit from the account as well, because obviously you get a match from the company and you get tax deferred growth and all that other stuff, right? That are benefits of a 401k. But that account exists because it is a tax write-off, basically. It's a benefit that your company offers, and they get a benefit for offering that benefit to you as an employee. That is why that account exists. It does not exist for your benefit.
Yep.
So typically when we talk to clients about leaving money in a 401k, They can go and change the parameters. They can change the costs, the internal costs. They can change the custodian. There's all kinds of different things, the fund lineups.
Right.
There's all kinds of different things that they can change that you have zero control over. Okay.
So, all right, if I can interrupt for a second, you said it right there. The big con to me on a 401k, the pro is the match. The big con is the investment lineup. You just said it.
Mm-hmm.
So if you look at a typical 401k and you look at the investment options that you have, you're going to have anywhere between 20 and 50 mutual funds. That's what you're going to see.
And 50's on the real
and 50's on the
side.
high end
That's
side.
very,
but when you do see that many, probably 15 or 20 of them are target date funds.
More than that.
Yeah. So if you know anything about target date funds, I like to call this investing for dummies. Remember the old For Dummies series of books. If you don't know what you're doing, target date funds are fine.
And quite frankly, that's not necessarily the worst thing in the world.
No, it's not.
For a lot of employees, especially like newer employees that are just starting out that don't know any better.
Bingo.
And and when we say for dummies, that's not implying that that's a bad option.
It's you don't know how it works, right?
Yeah. So,
but the problem with target date funds, I think the average person out there does not know how to use them. So you've got 15, 20 target date funds to pick from, and what we hear people doing. I've seen it a million times.
I want to diversify.
Right. I'm going to diversify. So I would like to have part of my portfolio be very, very aggressive. So they'll pick a target date 2060 or 2065 if it's out there, right? And I want maybe 20% of it to be very conservative. So they'll pick a 2025 one. You are shooting yourself in the foot. That's not how these work. So you want to walk through how you should actually use a target date fund.
Well, you pick the date that you're going to retire. Or a year reasonably close. Right. So, if you're going to retire somewhere between 2040 and 2045, you can pick one of those two dates, right? Because they don't make very many 2043 funds.
No, they're typically on
usually
the
in
fives,
five-year increments. But all that to say, you pick a date that you're planning to retire. And then every year that you get closer to that retirement date, that fund in and of itself internally becomes incrementally more conservative.
Bingo.
Yep. So there is already active management in place to control that risk profile that you were talking about, trying to use multiple funds to achieve. You don't need to use multiple funds to achieve. The entire purpose of a retirement date fund is that's the only account. That's the only fund in your account. You should not have any other funds if you have a retirement date fund in your account.
I saw this last week. I saw this in a 403B account for a teacher here in the area. When you're picking that fund, you pick that one fund. You don't, you don't mix them together, because the dirty little secret on target date funds is they are effectively the same investments in all of them. It's the ratio that's different, right? And what I saw in this particular 403B when I was doing the review for her was she had a target date fund for 2040, 2045, something like that, right? Which is still a moderately aggressive portfolio at this point in time. And then she had 50% in the S&P 500 fund, right? So she said, well, I wanted to be moderately aggressive. Let me explain something to you. You are very aggressive right now, because the S&P 500, I mean, just go look at the trend line on that thing. It's all over the place, especially in the last couple of months. If you're going to use target date funds, you only use one fund and you don't use anything else. You pick that fund and you stick to it.
It's amazing how keep it simple.
Stupid.
But the KISS method, it really is just the most effective method over the long term in most cases.
But that goes back to the investment choices that you have in a 401k. If you've got a bunch of target date funds in there, that's probably half of your options, and you should only choose that one. Mm-hmm. To me, that's the real downside of using a 401k as where you're going to put the old 401k funds as opposed to an IRA. So when you put it into an IRA, especially if it's one that's managed by a professional investment advisor, the number of options that you have to pick from is so much greater. It's basically anything that the advisor is licensed and willing to use. And I'll give you some examples. So, for example, we use almost exclusively exchange traded funds, or ETFs, in our portfolios. We used to use a lot more mutual funds. We made a switch because it was actually in clients' best interest. But I looked this up. This has been 7 or 8 years ago. We talked about in a 401k, you've got somewhere in the neighborhood of 20 to 50 mutual funds. right? There are over 29,000 mutual funds available on the market today.
Yeah.
Right. ETFs is probably a very similar number. So there's just so much more out there that can be used that is then customized to the individual or the individual client.
Yeah, and it also goes without saying, a lot of it depends upon the company or the custodian.
Correct.
So if you're with Fidelity, and this is not a knock on Fidelity, by the way, Fidelity has a lot of really good funds. But if your company's plan is custodied at Fidelity, guess what? You're going to have a lot of access to Fidelity funds.
Correct.
You're not going to have access to really much else. You might have a few sprinkled in, but for the most part, you're going to have mostly Fidelity, especially Fidelity retirement date target funds. So you once again talk about diversification. You're not nearly as well diversified.
There's just too many things that are available in an IRA that are not even on the radar in a 401k. We could talk about how you could position some of that money into annuities. That's not an option in a 401k. I'm not telling you it's a good option. I'm telling you it's an option inside of an IRA. Structured products, things of that nature. You can't get those in a 401k, but a good investment advisor has access to those and can actually position you in a customized situation for you. You just can't do that other way. That's why an IRA is, quite frankly, the place where you should move everything to, in our opinion. And you don't need multiple IRAs, right?
Yeah. No, you certainly don't. Well, the good rule of thumb is whenever you leave a company, move it out of the 401k.
Correct.
Even if you don't use an advisor, move it to an IRA, and you can still use some of the same target date funds in an IRA if that's what you like. And that's totally fine. So I see you.
I'm getting ready to start talking about whiskey.
We haven't talked about the bourbon.
Let's talk about whiskey. So let's start with this one. This is not bourbon. So for the people who are watching or listening who know the rules of bourbon, there are a list of things that are required. And one of them is that the juice, as we call it, the distillate, has to be aged in new white oak barrels, or American oak. White oak, American oak, same thing. This is actually aged in used barrels. So it's disqualified as bourbon. It's still whiskey, and it's still done right here in Kentucky, but it is not bourbon. It is a what we call an American whiskey, right? So that's the first thing. That changes the flavor because you're picking up things. A lot of that initial char gets used up by whatever they had it in the first time. I would assume regular Woodford Reserve. And then after they get finished aging with that, then they move it over into sherry casks. So if you're familiar with sherry, that's going to provide some sweeter flavors, things like that. I did look it up. There were two different sherry casks that they use. I saw the names. They mean nothing to me. I know what sherry is.
hard to pronounce.
I'm not very difficult to pronounce. I couldn't even begin to spell them. But it does provide some unique flavors here. I don't know about you. This would not be my everyday drinker. I like it, but it's not something I would want very often.
I like it.
I do like it.
It's very smooth.
This is 90.4 proof, I believe. Yeah. So this is not super high proof.
Yeah. It's if you're just beginning to start drinking whiskey, bourbon, this would be a pretty good.
Yes, I would agree. This is not bad.
For sure. It's not bad. I mean, I enjoy it, but I wouldn't go buy it.
Now, and therein lies the point. So there are two different variations on this. And you might say, okay, when I tell you that I taste some mild cinnamon, a little bit of honey, some baking spice, and I even taste raisins in that, which is kind of good, to be real honest with you. There's this version, which comes in a 375 milliliter bottle. And these are limited edition. I found this one at one of the big box places here in Louisville. My wife saw it last week and picked it up for me. It's the 2024 bottling, but there was a different bottling done in 2024. This retail is $65. The other one is $200.
Oh, wow.
And if I'm not mistaken, they're the same thing. And I'm telling you right now, $65 for this is pretty high.
Yeah.
$200 is off the scale high. There's no way I would pay $200 for a bottle of this. Yeah. The bottle is shaped differently. It's more of a traditional shaped bottle, but just be aware if you see this with 3 digits before the decimal, run, because that's way too much.
Don't misunderstand. It is good.
Yeah.
But especially in the world of bourbon today, right? You have to be very aware of value.
Correct.
And because I don't want to call this a marketing gimmick, but there's so many different versions of bourbon that are just, we'll take a bourbon and we'll age it in some fancy type of a barrel. And then we'll just slap a few extra bucks on the price tag, and
well, okay, so
and people will buy it up because they're collecting, right?
There is a reason why they do that. It's not just to make themselves stand out; it's because they're required to.
Yeah.
So the bulk of all the distilling that's done is done by a handful of companies. If you don't know anything about bourbon and whiskey, especially here in the Kentucky area, every brand that you go to the store and see, and there's hundreds of them, those are all not done at hundreds of different distilleries. They're mostly done at about 5.
Yeah.
And because they're selling the same exact product to everybody, they are required as part of the contract when they sell them to do something with it that makes it unique.
Yeah.
And that's why you get so much out there. And then, yes, it's a fabulous marketing gimmick. There's no question about that. One thing that I would caution, you were kind of talking about, be careful of these prices. The bourbon industry is starting to step into a little bit of a lull. The demand is not as high as what it was a few years ago. And because of that, you're going to start seeing more and more hard to get, quote unquote, things out there that are not so hard to get anymore. And with that, the prices will eventually come down. And I'll give you a great example. Everybody's heard of the Buffalo Trace Distillery. If you haven't heard of the Buffalo Trace Distillery, please go drink vodka or something, because we don't want to talk to you. I'll be a little bit of a snob there for a second. Their signature product, which is a fairly inexpensive product called Buffalo Trace, 3 years ago, that was extremely sought after. Here in Kentucky, you couldn't find it at any price. If you went 500 miles away from here, you might be able to find it, but it was going to be marked up. Retail on it, I believe, is $28.
Which it used to be never hard to find.
Exactly. It was never hard to find, and that's kind of the point. I have seen it on the shelf for $100 a bottle, which is insane.
Yeah.
Okay. But you never saw it here in the Louisville metro area, ever. I don't remember the last time that I walked into a liquor store and didn't see it. It's now becoming more and more available because the demand is not as high. And I'm not just seeing it at markups. I'm seeing it for $28 to $30, which is the suggested retail for it. And they've got a couple cases. It's not hard to find. If it's happening with one that's that well known, you know that's happening with the ones that nobody except the collectors know what it is. Right. So
I'm looking forward
to
that happening with Eagle Rare.
Yes, I would. I remember. You know what? We'll bust out some Eagle Rare for one of these. That's still one of my favorites.
Well, Eagle Rare used to be my go-to
when
I was broke out of college and living on my own. Eagle Rare, you could get a bottle of Eagle Rare for $25.
Yep.
And I always had Eagle Rare because to me it was like I found this crown jewel of bourbon for really, really cheap. And I was like, oh, this is awesome. That was always my go-to. And apparently other people discovered it too at some point.
A lot of other people apparently.
Because now you can't find it on the shelves anywhere. We were in New Orleans and we found it on the shelves.
Yes.
We had to go down to Louisiana to find Eagle Rare on the shelves. It was the Sazerac.
We were at Sazerac House.
Yeah, Sazerac House. In order to find it. But it's very, very, very difficult to find. It sells out pretty much immediately here.
And I remember when you could find that at any liquor store, big box, mom and pops, Kroger, didn't matter. They all had it. They had plenty of it. And it was at retail, which back then, to your point, was mid to upper 20s. I think the retail on it now is $45, $46 a bottle. And it's still very difficult to find, but I'm starting to see it more often. And that one is still for the price. If you can get it at retail, that's still a fantastic bourbon. But back to our Woodford, this is good. I really do like this.
There's no burn.
There's no.
There's really not even much of an aftertaste.
Yeah. The Kentucky hug that you sometimes get, I don't pick that up at all. Part of that's because it's only 90 proof. It has a lot of flavor for a 90 proof, though.
Yeah.
So,
it's not bad at all. I do like it.
Not bad. If you want something different, this is a good choice.
Yeah, or especially if you have company or you're,
We're having some people over to our house for Derby, and I guarantee you this one will be out on the table, and it will not get emptied.
Yeah.
Right? Everybody will try it. They'll say, I'm glad I tried it. I hate to say this, and maybe we'll end on this note. I'm going to be very much a snob right now. The best thing about it was the cork pop when we opened
No.
it before we started recording. So I don't mean to pick on it too high, but if I had it to do all over again, I would not have paid the $65 for it, which was retail.
Yep. So, well, going back to the purpose of us being here in the first place, right? Retirement planning.
Yeah.
One thing we did not talk about 401ks, and maybe we can get into this just briefly, was in-service distribution.
Oh, excellent point. Yeah.
And it's amazing to me how many people do not understand that this is another option with your 401k. Because we talked about the lack of fund options in 401ks, and I think that's actually even more prevalent on the fixed income side.
Oh, totally agree.
So
yeah.
As you get closer and closer to retirement, you have increased exposure to what's called sequence of returns risk, which means basically the order in which you receive your returns basically determines the success of your plan.
And when you say order of returns, just to clarify, that's you get a really good return this year, followed by a mediocre return, followed by maybe a negative return. It's the order in which you get those.
Yes, and sequence of returns risk doesn't really come into play until you start taking distributions from your account. Because if you take 10 years in the market, it doesn't matter the order in which you receive the returns over that 10-year period during the accumulation phase, because the average rate of return is still going to be the average rate of return.
You'll have the same dollar amount at the end of that 10 years, no matter what the sequence.
So it doesn't really matter too terribly much. As long as the returns are the same, the order doesn't really matter. What does dramatically affect the balance of your portfolio is when you start to take withdrawals or income, if you will, in retirement. So the closer you get to retirement, what you cannot afford to have happen is being overly exposed to a bear market or some type of a major event correction, which is what a lot of people, coming into our office right now are concerned about with all the volatility and all the, of course, negative headlines. And we talked a lot about that stuff already, but they're overly concerned about, well, I'm 2 years from retirement. Am I ever going to recover from this? Like, okay, well, let's make sure your portfolio is aligned in a manner to reduce your exposure. Yeah, there's that cork pop. There's that cork pop. So to reduce your exposure to that sequence of returns risk, because ultimately that's really the biggest threat that we see to the success of most retirement plans, especially if the goal of every single financial plan is to what? Not run out of money.
Not run out of money.
Which is what you said earlier, which is the biggest fear that retirees have. So that's what we have to solve for. So in order to avoid a sequence of returns risk, if your money is left in a 401k while you still continue to work, and let's say you're going to work till 65, that's kind of the benchmark, right? So you work till 65 and your money's in your 401k and you don't do anything with it. You can't really do a great job of preparing for retirement and moving into more risk-off types of investments prior to retirement. Because you are fully exposed to sequence of returns risk, really that 5 years. 5 years prior and the 5 years immediately following your retirement date. That 10-year window is like the riskiest portion of your investment life right there, because you're overly exposed. Like if you're 2 years away from retirement and you take a 30% drawdown in your portfolio, chances are you're not going to recover.
That's right.
Unless you have some miraculous V-shaped recovery like we did in 2020, which COVID, it's hard to compare that to anything, right?
But that was such an outlier. You can't ever put 2020 into into the way you model things.
Yeah, exactly. And because that was the most recent crash that we've had, people tend to assume, oh, we'll get out of it that quickly. No, we won't. That was the anomaly. That was the exception to the rule, quite frankly. So in order to prepare or to, better prevent, major losses, it's better to, do what you can to diversify, especially on the risk off side or the fixed income side. Quite frankly, and this is just putting it as nicely as I can, most of the fixed income investment options within 401k plans are not very good. They're very, very generic.
That was a very polite way of phrasing that.
They're very generic. And the other problem, we've talked about this and we've done podcast episodes on this before, is, the 60-40 moderate portfolio, is it dead, right? And the increased correlation between stocks and bonds and how they've become increasingly correlated over the last 2 decades. This year, knock on wood, fixed income has held up surprisingly well. But it did take Trump coming out and announcing that pause on tariffs in order to keep
that's right.
In order to keep bonds from completely collapsing, because they were very close to collapsing. It was Trump coming in and kind of negating that. But increasingly, you're seeing stocks and bonds become more and more correlated. Well, if you have all of your money in a 401k and we have a major drawdown in the market, and the only safe, quote unquote, safe option within your 401k are generic bond funds, you're still going to be mostly exposed. Bonds are still far more volatile than they really, really should be. So if you're trying to do a good job of staving off or preparing for the risk of sequence of returns as you enter into retirement, if you do what's called an in-service distribution, which you still continue to work for the company, but most companies generally about 95% plus. Once you hit the age of 59 and a half, will allow you to do what's called an in-service distribution. Some call it an in-service withdrawal, in-service transfer.
It's the same thing.
It's all the same thing. It's just different terminology. But what you can do is basically take the amount of money that you have in your 401k and transfer the balance, sweep that money out into an IRA. And you can then start to invest in different types of alternative investments, or not necessarily alternative investments, but better prepare your portfolio for your retirement date if it's forthcoming, right? Whereas you don't really have that great of an ability to do that because you're very handcuffed by the limited investment options that you have within a 401k.
Right. So kind of summarize that. We talked a few minutes ago about how the IRA is better than the 401k because the investment options are radically better. I mean, not comparable, right? Apples to watermelons, if you will. But if you're over 59 and a half, in most cases, you could go ahead and take advantage of that, even though you're still working for the company. And you're still contributing to the 401k and still getting that match, correct?
Mm-hmm. Absolutely. So you're still, any new contributions are still going in. You still own the 401k. We're just basically sweeping out the balance and moving that into an IRA, doing an IRA rollover. That way you have far better options to begin preparing for and for the eventuality to prepare for and live in retirement. You can start to do a much better job of getting ready for that within an IRA.
The analogy around that retirement date that we use, if you think about a mountain climber, right? So, climbing Mount Everest is famous. There is a point in time around 26,000 feet, if I remember correctly, that you are at the most danger. So you got to get to 29,000, but 26,000 is when the real danger kicks in because there's not enough oxygen. Your body actually starts dying. You got to get from that point to the peak and then back down past that point before your body dies, right? And we've even talked about there's a lot of people that are dead on Mount Everest, and most of them are on the way back down. So that's where that sequence of events comes in, roughly 5 years prior to your retirement date being the peak of the mountain, right? Mm-hmm. The day we have the party. And then the 5 years after. That's the danger zone for if the market goes sideways and you have not already taken that risk off, your plans might have just been changed pretty radically.
And so that's what we have to initially prepare for. That's the biggest thing we have to solve for when we're crafting an initial retirement income plan, is sequence of returns risk. We have to prepare for that. And it's really hard for us to, especially considering most people's, the bulk of their investment wealth is tied up to their employer plan. And so if you come to me and you do the right things, right, and you're preparing for retirement, maybe a few, ideally at least 5, should be probably 10 years prior to retirement, you're starting to work with someone. But it's hard for us to really do much or manage much if all of your money is tied up in your 401k. So in order to provide better advice, in order to provide our models, in order to, to do the things that we need to do to best prepare your portfolio for your retirement, that money cannot be in your 401k.
Absolutely. So let's wrap this up today. Just a little quick summary. Number one, you need to consolidate things. If you have accounts in multiple places, now we're not talking about what we call commingling. You're not mixing traditional IRA and Roth IRA. But we're just talking about consolidating all the different accounts that can be combined and getting them into one place because it's easier for you to understand. It's easier for your advisor to work with you and you're not getting contradicting advice. So that's the biggest one. When you start approaching 59 and a half, you really need to be looking at that in-service distribution. If you leave companies, get that 401k rolled over into an IRA as quickly as you can. Mm-hmm. And when you try this particular Woodford Reserve, don't mix it with water. If you were watching, I tried that with a couple of drops of water and
did you? Yeah.
Didn't do anything for it. It's better neat.
Yeah, it's not so strong where you need to.
No, exactly right.
Well, with that, I think that's a pretty good place to wrap up.
Yep.
So thanks for joining us on this edition of Retirement Planning Happy Hour. Until next week, thanks for joining Chris Vaughn, Eric Douglas, here with Family Wealth Planning Partners. If you have any questions, please contact us. Our contact information is on this YouTube page or as well as within the podcast episode. So thanks for joining us. See you next time.